Look around you, different things born out of truth and passion. Business software, it's our craft, our identity. Thoughtfully engineered, passionately designed to help you transform your business. Zoho, made in India, made for the world.
Welcome back. You're watching Buy Now, Sell Now from ET Now SBI Live Studio, and let's begin our viewer queries section. I have with me Narendra Solanki, who is the expert of the day, and our viewer from Bengaluru, Lakshmanan. Hi, good morning. How are you?
Good morning.
Yes, sir, you can ask your question.
Good morning, madam.
Good morning.
First of all, I'm thanking you for giving me this opportunity. After a long time, I am a long-time viewer of your TV. My name Lakshmanan, senior citizen, Bangalore.
Okay.
I'm a long-time investor and taking a lot of advice from Mr. Kunal and Mr. Shah and everybody.
Okay.
But today, my question is,
Sure.
I have been taken care of fundamental things and invested my 25% of my savings
Okay.
in HDFC Bank, Reliance Industries, L&T,
Okay.
SBI, some IT companies like TCS.
Sure.
Unfortunately, even I am going by the experts' advice, there won't be much benefit last 2 years.
Okay.
And last year I switched over to some mutual funds.
Sure.
That also not given much benefit.
So any
Whereas,
stock specific, sir, right now that we can ask Narendra? HDFC, ICICI, you mentioned. Anything else?
HDFC, RIL, L&T,
Okay.
like that. And one more thing, last year gold and silver and real estate shined very well.
Right, sir.
And the market, unfortunately, we didn't get any gain.
Sure.
And
Sure.
what about future things?
Sir, would you know the buying price of HDFC, ICICI, RIL, L&T, so that we can guide you as per your long-term time horizon?
Maybe continuously I invested.
Sure.
Not one-time buying.
Okay.
But unfortunately, 2-3 years, there won't be much benefit.
Exactly.
Okay. Strong recommendation.
All right. So let's help you out. Thank you so much for watching ET Now. Thank you so much for your viewership. We really appreciate that. Okay, so Narendra, HDFC, ICICI, RIL, L&T, he's not given us the buying price, but then he says that he's been investing in dips and he prefers to be long-term.
Yeah, good morning. I think there's nothing wrong with the stocks selection, but I think because these are large cap stocks, and we have seen that large cap stocks have not performed uh, uh, in comparison with mid cap and small cap counterparts. Having said that, I think he could continue to hold on to these shares because as and when the GDP growth picks up pace and the global volatility reduces, we could see the performance from large cap coming back to it because they are more exposed to broader economics and macro scenarios. Hence, they tend to perform in sync with the overall economy. And in H2, we think that with the good monsoon season and the festive spends picking up and the auto sales, which we have seen for the month of September, I think things should pick up in H2. So the performance could come in H2 with these large cap stocks. So he can continue to hold on to these stocks.
All right, so that's the take coming in on HDFC Bank and select other counters as well. But we also have the next caller with us. We have Mr. PVN Rao joining us from Hyderabad. Mr. Rao, hi, good morning. We have Narendra with us. Help us with the stock query that you have and you want to ask Mr. Narendra.
Good morning, all of you.
Good morning.
What are the fundamentals of Dronacharya Aerial Innovations? The stock is not doing well. What are the reasons? Can I buy?
All right. believe that the query is on Dronacharya Aerial Innovations. Narendra, I'm not sure whether you track this particular counter closely or not, but if you can help us with your view, if at all this is in your coverage list, and along with that, with respect to the other defense counters, any of the stock recommendations there?
Yeah, definitely. See, first of all, we do not have any coverage or recommendation on Dronacharya specifically, but in defense sector, we are very positive for medium to long term. Of course, there has been times wherein defense space has gathered a lot of enthusiasm, and because of that, valuations have also become very rich. So, whenever any
Exclusive interaction lined up for you. I'm Harsh Saita, with me Sajit Mangat, and we have the pleasure of having with us Gagan Banga, who's the Managing Director and CEO at Sammaan Capital.
Thank you.
Great having you, sir, on a day where you've had a big fundraise which has been announced, or a day after that. Talk to us about the contours of the deal. See, it's a $1 billion transaction, IHC coming in. Your capital adequacy has been quite solid anyway, 30% plus. What does this do in terms of both of those, your equity dilution to a large extent, but also what does it do in terms of growth capital? How much of this is confidence capital, growth capital? How much of it is to shore up capital adequacy and try and spur growth?
Yeah, firstly, thanks for having me over. And see, in our kind of a business, which is essentially we are a conduit between our borrowings and then we give loans. The foundation of this business is in equity, and equity is not purely defined by capital adequacy or tier 1. Those are technical regulatory requirements.
Sure.
The nature of the capital is defined by not only the quantum but the provider of that capital.
Sure.
And the quality of the foundation will determine how strong the building is.
Sure.
The building is built on 4 or 5 parts of debt. There is one part of equity. So what this transaction is essentially doing is solidifying the foundation. Right? We get to partner with, they get to control a large operating franchise, and we get to access funds which are not only very valuable from the sheer amount of money that is coming in, but as importantly as the investor and the strength that they bring from their size perspective, from their governance framework, and very, very importantly from their tech capabilities. So in their wider ecosystem, they have invested in several very high and cutting edge tech companies, and we hope to plug and play into that ecosystem. The way I think about our business, to be sort of future ready as to how lending would be happening 5 to 10 years from now, it's certainly not going to be happening how it's happening today. How we are reading credit today is not how we're going to be reading credit in 5 years.
Sure.
To be future ready, we needed capital. We got that. We needed interaction with tech. We get that. And the people who are with me, around me, have a lot of experience. There is tremendous institutional memory. So I think we have the right sort of a cocktail now to start growing from here.
While this entire acquisition re-rates your company because you have a sovereign-backed fund coming in and becoming the promoter for the company, I think the investors will be a little disappointed because it happened at 139 rupees and the stock was at 52-week high on Wednesday. How did you arrive at 139, and what do you have to say about the disappointment in price?
See, it's for the incoming investor to fundamentally decide and give an offer as to up to what price point are they interested in. The way I think about, if I was in their shoes, I would be very mindful of the fact that I am indeed bringing in a large investment, but I am also becoming the promoter of a company. NBFC business in general is a levered business, and therefore, while unlike businesses where you're manufacturing A and tomorrow you can use that waste to start manufacturing B, C and D, here you don't have that flexibility, right? You're a monoline sort of a business. Plus you're also taking ownership of practically backing up a large quantum of debt. And that large quantum would be, by 2028, our borrowings would be in the range of 1.2 lakh crore. By 2030, they will be in the range of 2 lakh crore. So if you're backing up that kind of capital, it's a very, very onerous responsibility, right? So I'm quite sure that that would have gone through their mind. The process is that the company, when approached, has to go through a valuation process. And the valuer will see what is a fair value of the company, what is the format as prescribed in regulations in terms of arriving at the price, and the higher of the two is chosen, which is the case which has been followed here as well. So the board has gone through the valuer's suggestions, taken the valuation on record, and then arrived at the right price for the investment to come in.
Gagan, if you look at the pricing, the open offer is also at 139. It's likely that it will not be subscribed in that sense. If that is the case, will there be further infusion to take the stake to beyond 51% from the new promoter?
So I'll answer that in 1 minute. Just continuing with what the point we were making a short while back. This is not about an investor coming in at a certain price point. This is about how a company which is well capitalized already, but is at 6, 7, 8% ROE, with this additional capital as a pool of both of the capital, the existing and the new, transforms to a high teen 20% sort of an ROE. That's the value unlocking.
Okay.
A sovereign coming in is great news. It's a one-time event. Now we are a sovereign backed entity. What now? The stakeholders are looking at how do we grow, how do we produce return on equity. That's what the minority shareholders are also looking at. So this is a transaction which enables the unleashing of 7-8% ROE to 17-18% ROE, right? Which is how, again, management is looking at this entire exercise. To your point on whether they would look to acquire more control or not, I think they would wait out to see what happens in the open offer. And then, basis how their overall thinking is, what are they thinking about financial services in India and so on, decide on their capital infusion plans. They do have a right of first refusal should the company choose to go down the dilution plan. What I can tell you is that in our business projections, at least till 2030, there is no requirement of capital. In 2030, if we have to meet our business objectives, we will still be at about 24-25% capital adequacy.
And at what rate would you be growing? Because if you're going to raise the ROE from 6 to 7% or 8% to 14%, what is the rate of growth that you're pegging?
More than growth, I think we'll break this up into 3 parts. The first 18 months is about making sure that our cost of funds comes down, where I immediately over the next 6 to 18 months see an improvement of as much as 170 basis points, right? By just the re-rating of the credit. Right? The second part is within the 6-18 months is the various other aspects of operating leverage, right? We have tried to run the company on an overcapacitized status, assuming that such a transaction will happen sooner than later. Now we can get back to focusing on getting efficiency out of that. So there is tremendous amount of leverage there. Cost income, which is in the 30% range, will come down to the 20% range, which itself will add, both of these together will add about 200 basis points to ROA, right? So that's the next 18-month journey. In the meantime, obviously with this backing, we can disburse a lot more. Our access to capital, debt capital improves, the quality of that debt capital improves. So I am fairly confident that by fiscal 27, our AUM should be 1 lakh crore. And if we were to look at getting the right ROA type of numbers, by fiscal 30, we want to get to $1 billion of profits. So those are the 2 goals that we are looking at. One is 1 lakh crore of AUM by fiscal 27. The other is $1 billion of profits by fiscal 30.
Wow. Okay, so that's steep in terms of guidance. I want to therefore try and understand what happens to the legacy book. You're obviously running it down, but we saw that you had a large provisioning in Q2 FY25. You also guided that your provisioning will be around at a rough 100 crore per quarter kind of clip going forward, but that slipped up a bit in Q1 FY26. There was one account which bothered you. How much of that is behind you is what I'd want to understand. How confident are you that a lot of this is now behind you and that you are able to match the guidance that you've given?
So it's in some ways, as long as we are running with this model of identifying a part of the book as growth, part of the book as legacy, that means your business is not equal to business as usual, right? So we are still continuing to run in a format of business as usual is not there, right? Now, what gets us to business as usual? Obviously, the legacy book unwinds. The credit costs on a steady state basis run at 100 basis points. What we are also very, very sure about is, which I've been saying for the last 3 years now, this is not the stage of the company where we should be releasing provisions. If we've done large technical write-offs, we continue to recover from them. Those recoveries should be trapped in the balance sheet and should not be released as profits, at least till the time that we are back to business as usual.
Sure.
So we will continue to trap. If there are recoveries, you will see elevated credit costs because we will turn them back into provisions and they will come as a provision line. That's the way that accounting statements are presented, right?
Sure.
So our steady state credit cost would be 100 basis points. And the aspiration is that by the time we are in fiscal 27 and this 1 lakh crore AUM is achieved, all of that 1 lakh crore AUM is AUM and is not growth, legacy and whatever else, right? And we will continue to follow the guidance on the legacy unwind that we've already provided.
Understood. So sorry, to get this absolutely clear, the 100 bips will exclude recoveries coming in,
Yes.
which will continue to come in.
Yeah.
And this is for viewer context, 100 bips a year, 100 crore per quarter is broadly the guidance that's set, and that's gross. So when you're looking at the net number, it'll likely be lower or maybe even negative. That's what we're really aiming for. What's that pool of unresolved assets or provisioning which you've already made, which you're looking to resolve? How large is that pool?
Which we've already provided, or which
Yes, which you've already provided and you're looking to resolve, which are resolvable in
we
your
have
opinion.
provided close to about 10,000 crores.
Yes.
We are fairly confident to recover at least 5 to 5,500 crores out of that. So this 5,500 crores, as it comes back, till the time that we don't get to a BAU state, we will continue to provide. At that juncture, we will see how we have to deal with it.
Sure.
You know, you're talking about 2030 as a target, and you're going to transform yourself as a tech-enabled NBFC. Is there going to be a different focus as well, different segments that you're going to focus as you push yourself to 100,000 crore AUM by 2027?
So I'm again breaking the period between now 26 to 2030 in two parts. There is a next 18 months where we have to get into a business as usual and thereafter growth mode. Post that, what is very clear is the segment of the customer that we are currently addressing, which is low to mid income, would continue to remain the segment. The product suite would expand. Today we are only focused on mortgages. The product suite would examine for us to critically examine any and every loan product which is required by the low to mid income segment of India. The way we are thinking about businesses, this is that one segment which has a heavy inflow in terms of the way that our demographics are. You know, I was surprised to read that between the ages of 30 to 55 of the new coming people, 68% plus are in urban centers, right? So that's the type of urbanization which is going on in India. Now, in that context, if we think about the next 20, 25 years, right, our Prime Minister has set a goal of India being developed by 2047. I am fairly confident of that, and thus I am extremely optimistic about my business for the next 20 years, right? And in the next 20 years, this is the most expanding segment. Now, whatever is required by the segment from a loaning perspective is what we will do at Sammaan. Whatever is required by the segment in a financial service perspective, which is not a loan, beyond a loan, a lot more is required. we'll do it in a partnership format.
That would be the unsecured portion of.
No, beyond loans. So beyond loans, if someone needs an insurance, we are already large corporate agents. We can expand that partnership to be more specific, right? There are so many other financial requirements of someone. If you're accruing 20, 30,000 borrowers a month, then to give them out those services becomes immensely profitable.
All right. I'm trying to understand, you're going asset light to a certain extent. Talk to us about the strategy there.
So asset light is something which, to my surprise actually, was very appreciated by IHC, right? So they think that securitization in one format or the other, every country has its own framework to do that, is the best way to be managing a balance sheet. So there is meeting of minds. The tweak can be both basis the regulatory evolution. So RBI has evolved the co-lending guidelines. Now it's no longer restricted to priority sector loans,
Yes.
etc. So the universe has significantly expanded. We will continue with this strategy. We will continue to do assets which we can always have a partner for. Now there is an optionality whether we want to keep all of that right now, keep it with a partner at inception. That flex comes in with this partnership, right? With this infusion. Asset light from a credit selection perspective is what we would continue to do. And I think both from a local regulatory point of view as well as the mindset of the incoming investor, we have the ground rules well laid out, but the ground rules give the a wide enough play field for us.
Sorry, sir. Just to kind of get to the point where if you're at 1 lakh crore in terms of AUM by FY27, that's the goal. What's the split going to be like on book versus off book? Give us that sense.
55,000 on book, 45,000 off book.
Understood.
And that would be the ratio, 50 to 60% on book, 40% off book.
Okay.
So, the stock has corrected after the announcement, and I think the price and open offer price is one of the reasons why it is. But by when do you expect the entire deal to go through? Because it's a financial services deal which requires multi-regulators to approve. So, what is the kind of timeline that you have for this deal to be completed?
Yeah, so indeed we are a regulated entity and NBFC in the upper layer, so fairly stringently regulated. In that context, my personal expectation is 6 to 12 months for the entire deal to consummate.
And what do you suggest to your investors? That should they hold on? Because the kind of guidance you have given is very aggressive guidance. You're looking at your AUM of 2 lakh by 2030, and next 2 years from 62,000 odd crores to 1 lakh crores, and ROE guidance is also very aggressive, almost doubling of ROE which is there. So what do you suggest to your investors?
Yeah, I can't make a suggestion in terms of whether they should own the stock or not. I can only,
if they're holding the stocks.
I can't. It's not my business to be making those kind of suggestions. It's yours and other experts to be telling them what to do. All I can say is that they cannot be a better combination from a point of view of the fundamentals for a business of our nature. There is consolidation in financial services globally. India is also going through that. We saw a wave of that in public sector banks. We know that in private banks there is clearly a few large private banks. I see no reason why the NBFC space 5 years from now would not be similar. So there would continue to be thousands of NBFCs, but there would be a select few very large NBFCs. And the one checkbox there which you will find consistently is a very strong promoter, which we have. It will require very strong operating expertise, which we have, right? More so now, as a management team which has gone through an existential crisis, survived, and is now getting back on the driver's seat. There is no more learning in the credit markets other than facing an existential crisis and then coming back. So we know we made mistakes, We've tried to rectify, we're living with those mistakes, we are correcting them every day. So all in all, I think it's a brilliant combination. It's a huge opportunity, right? There's a very strong partnership, and they cannot be a better lay of the land right now.
Understood.
Final question to you, Gagan. We are running out of time here. So, you are into the mortgage businesses, and what we hear is that there is some pain in the affordable housing part of it. How do you see that segment within your mortgage?
So historically, loans below 10 lakh of rupees have not behaved very differently to microfinance. So if there is pain in microfinance, there is pain in the below 10 lakh rupee home loans. Fortunately, we are not in that space, right? The lowest that we currently go to is 15 lakhs, 17 lakhs. And there is a very drastic difference between somebody buying a 12 lakh rupee home and somebody buying a 30 lakh rupee home. The income profile, the stability of the borrower and all of that. At this juncture, credit costs to me from the business that we are incrementally doing, I see no reason why 100 basis points is a challenge.
All right.
Okay.
That's all the time we have. In fact, thanks so much, Gagan, for coming in and speaking with us. And viewers, with that, it's a wrap on this edition of the show. Stay tuned to ET Now. More action on the other side.